Good morning. Thank you for joining FCLT Global's second webinar on investment risk. Our subject today is data inputs for asset allocation. We're joined by Will Kinlaw, Senior Managing Director and Head of State Street Associates. State Street Associates is State Street's academic affiliate and research arm of its capital markets and analytics division. Thank you for being with us today, Will.
My pleasure. Thank you.
FCLT Global's purpose in hosting these webinars is to apply our research. Our purpose as an organization is to help move money in longer term directions, and sharing information like we will today is one way in which we can do that. There's several content references that will be relevant for you today. The first is our own publication called Balancing Act, Managing Risk for Multiple Time Horizons. As a subordinate reference, some of that information is also present in our institutional investment mandates report. And then Will really is one of the world's foremost experts in this subject, and we'll be discussing two publications at minimum that he has out today. The first is one from 2014 called Divergence of High and Low Frequency Estimation, Implications for Performance Measurement, which was published in the Journal of Portfolio Management. Will also has literally written the book on long-term asset allocation together with Mark Kritzman and David Turkington. It's called A Practitioner's Guide to Asset Allocation. So you can find all of those online, FCLT Global publication on our website, and State Street also has the Divergence article on theirs. We are, of course, operating in a virtual room today. Technical difficulties may come up. If that is the case for you, we have someone who can help. Her name is Bryn Costello. Please send her an email at Bryn, B-R-Y-N, Costello, C-O-S-T-E-L-L-O, at FCLTGlobal.org if technical problems arise for you. We also will be taking questions electronically. Please submit those to my colleague, Victoria Tellez. That's victoria.tellez at FCLTGlobal.org. Will and I have a conversation that will unfold for about half an hour to 40 minutes, and then we'll begin weaving your questions into the conversation. But you can submit those at a time of your choosing to Victoria. This webinar is being recorded, and it will be archived on FCLT Global's website. This reflects our spirit in hosting the webinar itself, which is continuing professional education and dissemination of our research with the purpose ultimately, again, of moving money in a longer term direction through the way that we manage investment risk. We're scheduled for an hour today, and we do respect your time. We will end promptly after 60 minutes. Thank you all for joining us today. With no further ado, I'm going to begin the conversation with Will. So Will, the first question I'd like to ask is, what time horizon assumptions do investors make in today's process for building asset allocation?
Absolutely, and I'll definitely be happy to talk about that. And thank you for that overly generous introduction, Matt. And I also wanted to say thank you to FCLT Global. This is an organization that State Street is really proud to be involved with. Obviously, for many investors, as for us, long-term investing is so important, not only for what we do, but for the underlying clients and for the people that they serve. And I think FCLT Global is not only focusing on some important questions and aspects of this, but I think the way that you've gone about it with terms of getting investors together to share ideas and pool perspectives on these questions, so really facilitating dialogue is a great approach. And I personally, I know my colleagues also have found a lot of value in these sorts of sessions because you get good feedback and good ideas from people that have also been thinking a lot about these topics. So thank you to your organization for that. So your question, assumptions. So I think when you think about assumptions for asset allocation, there are a couple distinctions that you need to make. And one is that there's a set of assumptions that we make very intentionally and very consciously. And there's also a set of assumptions I think many of us, myself included, have made in the past that maybe we didn't understand all the implications of those assumptions, or we assumed that those assumptions were one thing when in fact they were another. So what is the horizon? Let's start there. I think, for most asset allocation decisions, when it's a strategic asset allocation, you think of the horizon being on the short end, say 3 to 5 years. and on the long end into decades. And I think, you may have some pension plans that are actually going to liquidate on, if it's a defined benefit plan that's very mature, maybe actually is going to liquidate in a 3 to 5 year horizon. But most plans, and certainly sovereign wealth funds, have much longer horizons. So when we talk about a 3 to 5 year horizon, what we really mean is not that the plan is going to liquidate or the fund is going to liquidate in that period of time. We mean that that's the period of time between which we really sit down and revisit our assumptions and look at our capital market expectations and take basically a fresh look at our strategy. So this is the explicit part of it, is understanding that we have this horizon. We're trying to come up with some estimates of what we think the capital markets might look like, what are the distributions going to look like over that time period. And that's usually very conscious and thoughtful. I think there are probably a number, but two that I want to point out. Assumptions that are much more implicit, subconscious, perhaps assumptions that we don't even realize that we're making. So the first has to do with the inputs. So usually when we construct asset allocation at a very basic level, we need to have some expected returns, which are hard to predict over short horizons, but get a little easier over longer and medium horizons. We need to have some risk assumptions, which usually we use standard deviation, and we'll talk more about that. And we also need to have some correlation estimates. So I'm talking here about the mean variance paradigm, but no matter what technique we're using, we need to think about these three at a minimum aspects of how assets are going to behave. Now, what we often don't think about is that for the return and the risk portion of this, we have to specify a periodicity. Are we going to specify these things with a monthly, a daily, an annual time period? Now, humans are kind of naturally wired to think about the year. It's the time it takes the Earth to do a lap. We do things on an annual basis, so it's natural for us to think about things on an annual horizon. And if the data we have isn't annual, we'll often extrapolate. We'll annualize to get there. And there's nothing wrong with that. I mean, at the end of the day, any period we pick is going to be arbitrary. There's nothing really wrong with a year, but we need to think about what are the implications of that choice. And we often blithely do this extrapolation without really thinking that through. So we'll take the monthly data. Very often for asset allocation, this is the case. We use monthly data. We come up with an estimate of volatility. We annualize it by multiplying it by the square root of 12, which the textbooks and all of our professors told us was a reasonable thing to do. For correlations, we often assume that the correlation doesn't change. So if the correlation between the two assets on a monthly basis is one thing, we assume that it's going to be the same correlation, that the diversification properties are going to be the same over longer horizons. So it sounds like a very kind of wonky, specific detail, but it's actually a really important one that's not only embedded in textbooks and courses, but it's hard-coded into risk software and optimization platforms all over the world. And it's an area where we've spent a lot of time doing some research, and the two papers you mentioned, Matt, really zero in on this and why it's important. So I look forward to talking a little bit about that. But that's one of the two kind of unknown assumptions that investors sometimes make. The other one has to do with a fundamental mismatch between the way that we typically compute risk and the way that we experience risk as human beings. So we, as human beings, we like to monitor things. We have apps on our phones that let us at any point in the day see how stocks are performing, see how our portfolios are doing. Boards, meet with a certain periodicity to review performance, and the frequency of review is usually much higher. We do it much more often than the investment horizon. If we asked you, what's your investment horizon, you'd probably specify it in years. But boards are certainly meeting more than once a year. We're monitoring portfolios more than once a year. But the way that we calculate risk, the textbook ways of calculating risk, are inherently end of horizon in nature. So if we're calculating a 1-year value at risk or a 1-year probability of loss, what that equation is telling us is the likelihood of experiencing that loss at the end of the horizon. Or if it's a value at risk, it's telling us what's the most we could lose with a certain probability at the end of the horizon. It's not telling us what could happen along the way. And what can happen along the way is extremely important, because if we're not ready for it, if we're not prepared, if we don't understand it, it could lead us to, at a minimum, have some very difficult discussions with stakeholders. But on the other end of the spectrum, we could actually be forced to deviate from a course that was actually the right course, just because we didn't understand the kind of loss that we might have suffered. So we think this notion of within horizon value at risk is very important. There was a paper called in 2001 in the Financial Analyst Journal that my longtime colleague Mark Kritzman co-authored with Don Rich, called The Mismeasurement of Risk, which won a Graham and Dodd Award from the FAJ, and just did a really nice job spelling out how we make this assumption and why it's so important to think about risk continuously. And in fact, just as an aside, Don Rich passed away last week unexpectedly, and many of us who knew him were really disappointed to hear that. He was a great contributor to our field, and I think this was one of his seminal papers. So I was pleased to be able to talk a little bit about it today for that reason.
Thank you for that. We're certainly sorry to hear of his unexpected passing. Thank you for sharing that as well. I want to go a little bit deeper for a moment. We've talked about some assumptions. I think it's really interesting how you distinguish between intentional and perhaps unconscious or unintentional ones. I presume that there are limitations, maybe also advantages to making those assumptions. Can you talk about what the limitations may be and why particularly it matters for a long-term investor?
Absolutely. So let me start with the first set of assumptions, which is to do with this notion of the periodicity, right? So we call this divergence. You mentioned the title of our paper, which is probably one of the least exciting paper titles of all time, The Divergence of High and Low Frequency Estimation. It doesn't really grab you. But when we say divergence in that context, what we're talking about is this notion that oftentimes as investors, we use daily or monthly data, and we come up with parameters like standard deviation, and we annualize them to get to an annual number, an annualized number. And when we do that, what we're implicitly assuming is that returns are independently distributed, so that returns each period are not related to returns from the last period. In fact, in many cases, that is not true. And as a result, the extrapolated estimate of what risk would look like at an annual horizon can diverge from what it actually looks like on an annual horizon because of that lack of independence. So when we say divergence, we refer to this whole kind of field as divergence. We're talking about that divergence between what you extrapolated, assuming things were nice and independent, versus what actually can be realized. This is where, if I could, Bryn, if you wouldn't mind, please pulling up those 3 slides. I just wanted to share a really crisp example. And this example is a little bit dated, but I actually updated it recently, and qualitatively it still holds very well. So this is from our paper. This shows the correlation of monthly overlapping returns. Sorry, these are non-overlapping. So these are monthly non-overlapping returns between US equities and emerging markets. And this was as of through the year 2013. And around that time, we were kind of scratching our heads, as were a number of investors, because the correlation, if you look at this correlation between US and emerging markets, it's pretty high. It's almost 70%. And yet, if you looked at the several decades leading up to that point in time, there were periods where emerging markets outperformed developed markets, as I recall, by as much as 120% over a 3-year period. And there were also periods where emerging markets underperformed US equities by 60%. So you have these massive divergences in the performance, yet you have a very, very strong correlation. And you kind of scratch your head and you say, how can that be? So this is data from 1990 to 2013. Now, if we could just advance to the next slide. This shows overlapping 1-year period. So same exact time period. We're not looking at a different time period here. Looking at, the classic issue we face, the estimation error we're used to dealing with in finance, is that we're trying to predict the future with the past. And the future rarely looks exactly like the past. So that's estimation error, and that's not what we're talking about here. This is looking at the past, the same period, through a different lens. And what we see is that the correlation when we look at annual observations drops to 44%. Now, if we'd advance one more, please, Bryn, you'll see the numbers here for 3-year events. So these are 3-year horizons, and it drops basically to 0. So this should not happen. When we estimate correlations with monthly data and we use them for long horizon investing, we're implicitly assuming that they're going to be the same, that they're going to be invariant to the time horizon. Similarly, when we estimate risk from monthly data points, and we extrapolate to an annual risk, or use it in a calculation to come up with our 3-year chance of underperforming our benchmark, we're assuming that it's going to scale nicely with this growth of time. And in many cases, and this is an extreme example, but it's not an outlier. I mean, there are many pairs of asset classes where you observe behavior like this. So this is, I think, a really nice illustration of what's going on. Why is the question. So why is this the case? Why aren't returns independent? So let me give you a few different perspectives on this. Many of us, whether we invest in momentum strategies or not, we at the very minimum may think of momentum as a factor. We could debate if it's a factor or not, but the very existence of momentum as a strategy is an implicit belief that there is some autocorrelation in returns. Momentum is telling us that returns from previous periods are relevant to the current period. So if you believe momentum exists in some context or some points in time, then you're implicitly acknowledging that there's some autocorrelation, and that this sort of phenomenon that I've just illustrated for you can happen. There are some behavioral issues at play here too. So my colleague, David Turkington, has a paper, I can't recall if it's out yet or coming out in the FAJ, where he looks at a new factor that he and the team have discovered that relates to currencies. And the factor is looking at the local equity market return in the prior period. So it turns out there's a correlation between prior period local equity returns. So think of return of equities in Japan. Can have, for last year, can have information regarding the performance of the yen next year. And it seems like there's some dynamics in terms of the way investors behave and rebalance that can make this the case, but certainly statistically it's there. So that's one example of kind of a lagged cross correlation between two assets. Some asset classes, just by their very nature, the way they're built, have some autocorrelation. So think about bonds. Bonds pay a relatively consistent coupon in most cases, right? Which naturally introduces a component of autocorrelation into their returns, which you'll observe in many instances if you look at their total returns. Private markets, by their very nature, the way that private markets are priced, private markets transact rarely, if ever. And when they do, we don't usually know those prices. So private markets, to come up with their estimates of risk and valuation, we rely on appraisals, which are inherently anchored to prior period appraisals and comparative companies. So the returns for infrastructure, private equity, private debt, these series are notoriously autocorrelated. And as a result, their risk over longer horizons is much, much greater than you'd anticipate by extrapolating their risk over shorter horizons. And there's an aside on this. We're actually doing some work on this, because one of the ways that investors try to estimate the risk of private equity is using their leverage. And I don't want to go down a rabbit hole here, but a very common approach is to say, well, look, private equity is twice as levered, just for example, say, as public equity. So let's just take the volatility of the S&P and multiply it by 2. And that'll give us, or maybe we take a small cap index or something we think captures the type of companies that are in private equity, multiply it by 2. Theoretically, that approach seems sound, because we know that risk should, or volatility, to use them synonymously, should scale with leverage. But in practice, that's actually not the case. And even if you look at the cross section, this is fascinating, but if you look at companies in the S&P and you look at the scatter plot of the relationship between leverage and volatility, it's non-existent. It's actually slightly negative. And the same seems to be true for private companies. And the reason is that it's endogenous. Companies that can lever more because their business is inherently less risky, they lever more. Companies that can't, don't. So you don't end up with, you have this fundamental business risk you have to adjust for, and it's actually really, really hard to adjust for. So we actually find that this approach of using the volatility, the leverage multiple, is not a good way. It causes you to overestimate the volatility of private equity. We have a paper coming out called the leverage myth, private equity and the leverage myth, that really explores this phenomenon. But bottom line, private markets are another place where this assumption breaks down. So think about it finally from just a kind of intuitive perspective. We think that the drivers of risk and the drivers of variation in returns are different over long periods versus short periods. So one of the experiments we did in the second paper that you mentioned, Matt, was to look at what drives volatility. If you look at the dispersion in just US sectors, so you have 11 sectors, real estate, telecoms, and so forth. What drives the dispersion in their performance? It turns out that if you look at shorter periods, like daily returns, it really more has to do with just changes in discount rates that seem to drive so we looked at changes in betas, but basically that drive the variation and the variability in the returns across sectors. But if you look at longer horizons where more information becomes available about earnings, actually earnings then usurp discount rate changes as describing most of the variation. So that's actually pretty interesting if you think about it. If you run a regression, same exact explanatory variables, same dependent variables, and you're trying to just, all you're doing is changing the periodicity of your inputs, you come to completely different conclusions about which variables are most important. And it's because of just the frequency with which the information arrives and how we react to that as investors. So the very drivers can be different. So before I just want to quickly cover off on that second assumption about within horizon risk. Before I do that, why do we care about all this? Why can't we just annualize and forget about it? Why does it matter? It matters because it's hard-coded everywhere, and it's in many cases incorrect. And it can lead us to misallocate. So in the case of, I showed you with emerging markets, we could basically completely underestimate the potential for emerging markets to diversify US equities over a long horizon. We also, if we were taking a position, say we were going underweight emerging markets or overweight emerging markets relative to our benchmark, we could very much underestimate our likelihood of underperforming that benchmark, because we're assuming the correlation between these two things is high. We're taking a relative position, long one, short the other, or overweight one, underweight the other. And we're assuming that because they're relatively correlated, that doesn't have much potential to drive our performance, when in fact, over a longer horizon, it does. So it can really lead us to make an incorrect estimate of our risk. And in the paper, we show an example where we actually underestimate our risk of underperforming the benchmark by 50%. So it's double what we thought it was if we're just using this assumption. And we'll come to this in a moment. I know I was really pleased to see that you have someone from the CFA Institute, I think, on the next one of these webinars. This assumption, the requirement to annualize volatility using the square root of 12 is hard-coded into the GIPS. So if you're a manager, an investment manager, and you want to report your Sharpe ratio in a way that's compliant with the GIPS, you are required to use monthly returns and annualize them with the square root of 12. And by the way, not a knock on the CFA Institute. I am a proud CFA charter holder, and it's a fantastic organization, and we're big fans of the Financial Analyst Journal. But I know they're also an organization that values debate and transparency. And this is something I think should be a topic of discussion is, should the GIPS acknowledge or in some way adjust? Because what we found is we found some hedge funds that if you look at their risk over a 3-year period versus a 1-month period, they drop from top quartile Sharpe ratio to bottom quartile. So it can really meaningfully impact the way that we measure performance as investors. So just really quickly on that second assumption on the end of horizon versus within horizon. I know we previously had a great discussion, Matt, that FCLT organized that had a number of institutions, including GIC. And Kevin Bong, I don't know if he coined this phrase or not, but I recalled very, very, very well what he said, which is that it's not always about predicting, but about preparing. And within horizon risk is really important to help prepare because it helps stakeholders understand what sorts of drawdowns they might experience and be ready for those discussions. We all remember this famous John Maynard Keynes quote that he says, "In the long run, we're all dead." And what many people forget is what he actually said after that. And I've written it down because it's great. He said, "But this long run is a misleading guide to current affairs. In the long run, we're all dead. Economists set themselves too easy, too useless a task if in tempestuous, stormy seasons, they can only tell us that when the storm is long past, the ocean is flat again." So in other words, if we just can say that at the end of the horizon, it's going to be X, that's not really that useful when you're in the middle of the storm. And he's really talking there about within horizon risk. And to survive the long run, we have to be able to weather the short run. And a big part of that is knowing what sort of events we might experience in the short run.
Thank you for all of that. I'd like to quickly unpack a few pieces of that before we move on to audience questions. One is, I found that your reference to momentum as a factor or potential factor is really illuminating. This can bring it up from a level where somebody deep in the practice of risk might know, but somebody else might not. Let me make sure that I understand your point correctly. An assumption common in risk practice today is that momentum doesn't exist. Is that true?
Well, I think that is an implicit assumption. If you are just blindly annualizing everything with the square root of 12 and simultaneously investing in momentum strategies, what you are doing is there's an inconsistency there. It's not necessarily that either approach is always wrong. Sometimes momentum works, sometimes it doesn't. Sometimes the square root of 12 works, and sometimes it doesn't. But if you're acknowledging the existence of momentum, you're also acknowledging that there's some autocorrelation in returns, and you need to then consider that when you annualize using that simple square root of time rule.
So the next question I have is about the translation into behavior. FCLTGlobal exists for this purpose, and we oftentimes find that our members and others understand that something needs to be different than it is, but that it's hard to change. And so I'm curious your experience, and I know that you've briefed this subject to many investors, whether you're telling folks generally something that they don't know, you're providing new information, or whether there's another barrier to change for adapting to your information. So let me ask you a really simple question. Do you find most investors know what you have just briefed out, or are you bringing new information to the conversation?
So I think the beauty of this is, and this is start off that way, it sounds like it's self-aggrandizing, but it's actually self-deprecating. I mean, it's very simple. I mean, what we're presenting in these papers is extremely simple. Everyone understands that the IID assumption, in particular that first I, the independent, is an important assumption for annualizing the way that we often do at the square root of time. Everyone knows that. And I think everyone also knows that it's not literally true that returns are completely uncorrelated. But I think in our conversations with investors, many of them just didn't realize perhaps the extent to which it can be a false assumption and the extent to which it can matter. So we found, going back to this notion of divergence, one of the exhibits, and I should have brought this slide, but I didn't, but one of the exhibits we like to show is a bell curve which would show the distribution of outcomes you'd expect from extrapolating. So using monthly and extrapolating with the square root of time to 3 years. And then bars overlaid on that showing the actual distribution of 3-year outcomes. And what you see is fat bars in the tails, right? And so in other words, the actual distribution of 3 outcomes can lead in some cases less, but some cases greater dispersion in the tails, more risk. And many investors would probably assume that this is something different. This is to do with kurtosis or skewness or kind of non-normal distributions, fat tails, right? But in fact, we find in many of the asset pairs we looked at that this divergence effect can be a bigger deal than fat tails. And if I'd asked a conference and asked people to raise their hands or vote, I'm betting most people would say fat tails are more important and a bigger deal than thinking about this divergence issue. And in fact, in many cases, the divergence issue is as important or more important. So I think we haven't discovered anything here that nobody understood. There's no new math. It's really just highlighting a common assumption that we all make that's hard-coded that we should take a fresh look at and just think a little bit more carefully about. So it's an easy remedy.
I appreciate that. I'll tell you and the group as well what I hear from that. And that is understanding the magnitude of the effect may be necessary to revisit some parts of the practice. Let's move in that direction now. We're talking specifically about long-term investing and long-term investors. In light of everything that you've shared with us, what are longer-term practices for projecting volatility, building asset allocation, and evaluating diversification?
Absolutely. So let me be brief because I'm really keen to hear some of the feedback and perhaps questions or challenges. Just on the two things I've highlighted and then one additional point. So in terms of this divergence issue, it's very simple. We just need to look at the autocorrelation and potentially the lagged cross correlations. So if we're investing and we're devising assumptions for our asset classes, do we see evidence that there's significant autocorrelation in their returns? If there is, this issue may be at play. An easy way to do that, by the way, is also just do the monthly correlation and volatility, and then annualize that or try annualize that, and then look at the actual look at overlapping 3-year periods and see if they're different. And if you see big differences, then there's evidence historically that there was some divergence, and then you have to decide why was this? And do I think this will persist? And is it something I should build in a forward-looking way? If it doesn't, and it doesn't exist everywhere, I mean, in many cases, the square root of 12 rule kind of works very nicely. So if it doesn't exist, then you have less to worry about. So that one is really, frankly, pretty easy. In terms of within horizon risk, it's really just understanding the standard value at risk equations and probability of loss equations that are hard-coded. If we're using a risk platform, asking the question, what are the assumptions here? And getting to a within horizon estimate of exposure to loss. My co-author and colleague, Mark Kritzman, wrote a paper, wrote by himself back in 2007, shortly before the global financial crisis, where he was making this point. And he had a sample portfolio. It was a very typical institutional portfolio. And he calculated its risk using the kind of traditional equations. And then he calculated it for a within horizon kind of turbulent equation. So I'm going to come to this turbulence point in a moment, but he's basically looking at what's the most it could lose within a 3-year period or a 1-year period, assuming that we're in a more turbulent environment. And it was multiples. The size of the loss was multiples of what you would come up with if you just use the standard numbers. And actually quite close to what happened in the global financial crisis in the following years. Not to say that it was predicting that crisis, but it was saying even using data prior to that crisis, and the data wasn't going back. I mean, it didn't include the Great Depression or everything. It was a few decades prior to 2007. The point is, if you'd looked at risk this way, even using those inputs, which didn't yet bake in that crisis, so it was out of sample, you would have come up with a conclusion that, okay, we can experience a loss of 40% in a reasonably diversified portfolio. It's not that outlandish of a possibility, which I think, just gets to this point of helping investors prepare. And then the third point, which is different than the other points that I've made, has to do with the very nature of volatility itself. We often forget, volatility is an average. It's the weighted, it's an average of the squared deviations from the mean. And the way it's typically computed, now some people do GARCH and other models, but the way it's typically computed, the historical deviations from the mean get equal weight. And what we're implicitly assuming there is that they're all equally important. Each month, each day in our, each quarter, whatever we're using in our history is equally important. And sorry, I'm a sucker for a good quote, so indulge me if you would in one more. I was listening to this podcast called Blueprint for Armageddon, which is great. It's about a really fascinating history of World War I. And I came across this quote from Vladimir Lenin, where he said, there are decades where nothing happens and there are weeks where decades happen. So he was talking about the seismic geopolitical events surrounding the First World War. And given his own philosophies and leanings, he probably wouldn't like the same quote being applied to the modern capital markets, but it's, I think, nonetheless very relevant. And his point is that there are a lot of periods of time where no events are really occurring or not major events. And the data we get from those periods is kind of just statistical noise. And then there are those weeks where decades happen, where information is entering the markets, markets are reacting. Do we really want to dilute the information from those periods with all those quiet periods and lose them in the statistic? So one of the areas that Dave Turkington, Mark Kritzman, Megan Sazonis, Sebastian Page, who's no longer at Satcher Associates, was a colleague for a number of years. One of the areas we've looked at quite extensively is this notion of financial turbulence, and how can you isolate these periods where, the weeks where decades happen, and extract the information from those. How do correlations change? How does volatility change? And even though, you can, obviously the events are all different, but sometimes there are patterns in the way assets react that are actually quite similar, even though the causes may be different. And what we find is if you start to think of the world more as emanating from two distributions, a quieter distribution and a more turbulent distribution, if you allow for that flexibility of two distributions, there's an advantage, because you can still model things using all of our usual tools. You don't have to throw away mean variance analysis. You don't have to throw away value at risk, and deal with fat tails and everything. And oftentimes, if you model things with two distributions, what looks like fat tails goes away. You don't see kurtosis anymore, because what looked like kurtosis is now being captured by this other more turbulent distribution. So we are big believers in this approach as kind of a way to see the world. And it's really helpful as a way to stress test. And again, help stakeholders understand these are the way things can change during these environments. This is the kind of loss we might expect, and why we might need to be ready.
I would be remiss if at this moment of crisis we've experienced in the past 6 months, I didn't ask if there's application, what you just said, the crisis that we just went through and potentially are continuing with.
Yes, well, there's a number, and I'll be brief. So we've been using this approach to look at economic data. So to help understand, it can actually help tell us for different types of economic data that are all expressed in different units. It can tell us the likelihood that we're currently entering a recession or a growth period. And it was actually quite useful late last year in indicating that data, even before the pandemic, obviously became a pandemic, that there was some fragility in the economy that maybe wasn't appreciated qualitatively. It's got a number of other great uses. My colleagues have been using it to, they've got a paper coming out using it to forecast elections. So they've been looking at presidential elections and identifying which elections in history are similar based on certain criteria to the one we're facing today. So they've got a paper which is predicting purely objectively based on data that Joe Biden will win this next election. It would have, by the way, also predicted Trump winning the election in 2016. So it's a really useful, it's called the Mahalanobus Distance as a statistical measure. And it was actually invented by an Indian statistician in the early in 1900s, I think the 1920s and early 1930s, who was using it in a more of an archaeological concept to actually compare human skulls and different measurements of the skulls and sort them into different racial groups, which is it's fascinating. But the same statistic, which takes data from different observations and recognizes that not only can correlations change during different environments, but also the kind of the volatility in different regimes, the volatility can change. So it's not just the level that matters, it's the relationship between the different variables that can also be important. And that's by the way, one of the issues with, if you look at some of the standard indices that are supposed to track the economy, they average different variables together. So if you have one variable that's gone up significantly, another that's gone down, that just washes out in the average and it looks like nothing's happening. But oftentimes that separation can actually contain information. So looking at things through this lens, and this could be a whole separate topic, but looking at things through this lens can be a really helpful way to not only measure risk better, but also do better regressions, analyze economic data, all sorts of different applications.
Thank you for that. I'm going to ask one more question, and then I have one submitted electronically from Mark Blair at Ontario Teachers and Tim Hoffman at Bailey Gifford. Mark and Tim will get your questions after my last one. I would also remind audience members that if you have a question for Will, please submit it to victoria.lez, E-E-L-L-E-C, at FCLTGlobal.org. So Will, my last question for you falls in the category of other status quo practices that long-term investors could question related to the use of statistical volatility as an indicator of risk.
Well, I think the one thing that I've probably neglected is, that the whole notion of whether the normal distribution is appropriate. And I don't mean to be dismissive of that. I think there are many cases where, it's not. And there are tools that can be used to address those cases. But I think that's you have the notion of the black swan, and I think that's an area that's in our profession received more attention and is well understood. And the reason we've chosen, I've chosen to highlight the topics today that I've chosen to highlight is not because I'm trying to ignore those other topics. It's just I think they're simple. The things I've highlighted are simple, but they're just perhaps not extremely well appreciated.
Thank you for that. So I'm going to go to Mark's question first. Mark, again, from Ontario Teachers Pension Plan. Mark references potentially a trade-off between longer-term data being better and older data being less relevant. And so as he thinks about the conclusions of your research, he has a question about thoughts on managing this trade-off. Do you have anything that you would suggest there?
Yeah, that's a great point. So I think if I just paraphrase the point, I think what Mark's saying is that in order to understand how things behave over longer terms, you need to go back further in history to get that data. And when you go back further in history, inevitably you enter periods, before Bretton Woods, whatever it might be. You enter different regimes, different environments where things are going to behave differently. You enter periods where maybe inflation was really high, and so you have that issue. are they still relevant? And I think that's a great point. And I think the part of what I was trying to highlight in particular, if you think about divergence, this point that when you extrapolate from higher frequency data to estimate what will happen over the long term, it's very easy to look at data, monthly data, and determine whether there's significant autocorrelation in that data. And I don't need to go back very far to do that. I could go back, 30 months, and I could have a pretty significant estimate on a monthly basis that I'm observing autocorrelation. And so then I know that this is something I need to think about and adjust for looking ahead. If I have a good intuitive model for why I think, and I gave a few examples earlier, but why do I think that autocorrelation exists? If I know it exists, then I know I need to think about it and model for it. And I don't need to go back 3 decades to basically prove that it exists. So I'm not dismissing the point. I think it's a very valid point, and I think there's a classic trade-off that we face in terms of being statistically. We want to have the relevant history, which forces us to go, get less and less data. We want to have statistically useful data, which forces us to go further back, and that is an inherent trade-off. And I don't have a magic solution to that. I think it's a trade-off where we just have to use good judgment. I will also point out, Dave, some of my colleagues, Dave Turkington, Mark Kritzman, Megan Suzonis, have a paper coming out they introduce a technique called partial sample regression. And I mentioned earlier this regression tool they're using to predict presidential elections, and they're using that tool, partial sample regression. And the idea is to identify historical periods that are relevant to today. So, where is the data behaved like it's behaving today? And what they find is that, and I'm simplifying it, there's more to it, but if you give those periods more weight in your forecast, you can get a better forecast. And they show that in a number, they forecast factors, presidential elections, a number of different things. So I think there are also ways to try to identify the parts of history that may be most relevant to today. To avoid a little bit this issue of including periods that aren't relevant. But I grant that's a tricky problem that we have to balance, and there's no silver bullet. I think the 2 things I've just highlighted are potential ways that we can address it in practice.
Sure, thank you for that. Tim Alcorn from Bailey Gifford raises a provocative question, and that is potentially about the need for wholesale change. You've identified how there's assumptions embedded really throughout the practice that might be specified or precise. And you can imagine a world in which their magnitude was so great that you just thought about managing investment risk in a different way. I don't per se know what that way would be, but you might think about a wholesale change in the system. I can relate to that emotionally, where you kind of hear that there's challenges embedded in places that you might not expect in your practice, and you're tempted to just say, we need to do something else. Can you address the potential need to reimagine the way that we manage investment risk, or whether there's adjustments to the current practice that are sufficient for long-term investment management?
That's a great question. I don't know if I'm qualified to answer that question. I'll offer a view in the context of the things I've spoken about. Look, I think that many of the issues that I've highlighted today can be addressed by combining good judgment with the existing statistical tools that we have. So I think what it really comes down to is not, I don't know that it makes sense to throw away, for example, the whole mean variance paradigm, because I think there's a lot of research that, yes, it has some limitations, but it's actually surprisingly robust in many contexts. I think it's just about understanding what its limitations are and stress testing a bit for those, making sure that stakeholders understand those limitations, and trying to do some of these things to address them. Whether that's, not necessarily weighting historical observations equally, whether that's, not necessarily blindly extrapolating using a square root of time rule, whether that's showing a within horizon chance of loss alongside an end of horizon and talking to a board about the difference. I personally, my take is that it's more constructive to try to expand and just think about the current frameworks in ways that can address some of these shortcomings, rather than throw them out. And that may only be because I'm not smart enough to come up with a new paradigm to replace the existing paradigm, which would be challenging, right? Because you have to get stakeholders comfortable. There have to be a lot of research, and there inevitably be challenges to that. So I guess my without having thought about it as carefully as the question deserves, that would be my take.
So I'm going to come back to the points that you put on the table about judgment and discretion, but I do want to get another question from our audience. Peter Grant has spoken up and really to revisit and go into some detail about the point that you in the conversation. This question is, you make the adjustments that you described. What have you found is the net change on typical allocations to things like emerging markets or non-US, et cetera? What happens when you do this?
I see. There was an audio issue there. I think, Matt, I got the question, which is just like, what are the tangible outcomes that you'd observe qualitatively in a portfolio when you do this?
Changes to allocate. Yes.
Yeah. So that's a great question. And our paper shows some of those results. Of course, the issue is that it's going to, I mean, I sound like a consultant now, but it depends. The issue is it's going to depend on the assets in the portfolio and many other things. But a few concrete examples. So clearly, based on what I showed you, and that scatter plot phenomenon, but the between U.S. and emerging markets, I updated that. We're actually working on a second edition of our book, so I'm updating. We have a chapter on this issue, and I'm updating some of that right now. And qualitatively, it's the same pattern. So what does that mean? That means that all else equal, if you're looking at a longer horizon, you're going to hold more emerging markets because it actually diversifies your main growth engine, which is, we used U.S. equities. So for you, a U.S. investor, if your main growth engine is U.S. equities, it's a better diversifier than you thought it was. So you're gonna end up, all else equal, holding more of it. So that's one very concrete example. I think you're also going to find that you're, as I highlighted, when you are looking at, if you're taking a position relative to your policy portfolio, say you're overweighting emerging markets for a period of time, the relative risk that introduces to your policy portfolio is higher than you'd assume because the correlation is actually lower. So there's a larger chance you could underperform your benchmark than you'd assume if you just extrapolated blindly. I think with some other concrete points. So look at private equity. It depends, again, but it depends how you're estimating the risk of private equity. So if you're today using that leverage multiple approach that I described, which we feel is not the right approach, you've actually got, and many of our clients, many of State Street's clients, because of their size, when they look at private equity, they're really looking mostly at buyouts because venture capital just doesn't have enough capacity for them to enter that market in size. So they're looking at buyout funds. And if you're estimating the risk of buyout funds by using a leverage multiple, you're probably overestimating it. So you're under allocating to private equity, all else equal, versus if you measure it either by de-smoothing returns or by looking at longer return intervals, as I described, you're going to find that the risk is actually lower than you thought. So in that case, you'd probably allocate more to private equity. Those are a few examples, and there's more in the paper, but it does come to, I think, some very concrete points of how a portfolio would look different and how your risk would look different. And I think what's important is not just to accept them, but to say why. What is driving this difference? And if there's some autocorrelation, why do we think that is? And do we think that will persist? And again, I gave some examples of cases where there may be good argument that it would persist.
I appreciate that. I'm going to use that as a segue to something you said earlier as well. You mentioned our friend and colleague, Kevin Bong from GIC, and a point that he's made in earlier dialogue that FCLTGlobal moderated about the difference between preparing and predicting. It gets at what seems to be a very important and fundamental issue here, and that is that you cannot mathematically solve for the future, but that there is discretion and judgment and all manner of qualitative activities that you undertake on the basis of the statistical math that you've just described. I'd like to go into that a little bit. You mentioned, for instance, the distinction between end of horizon and within horizon risk. And that's really been significant for our research and for the uptake that we've seen among investors. Can you talk about what usual statistics tell you about the pathway of your investment, and then the qualitative or discretionary ways in which a long-term investor will understand that information, communicate risk, understand what they may be facing, and put it to work?
Yeah, I can make an attempt at that. I think so. So just to recap the issue, if you Google value at risk right now, you'll get an equation, and that equation is it's telling you the largest loss that you would expect to suffer over a certain horizon with a certain probability. So if you set that probability at 95% confidence and it's a 1-year horizon and it's 200 million euros. What that's saying is that there should be only a 5% chance that at the end of 1 year, you're going to be down more than 200 million euros. Now, you can challenge that equation and that model and from a number of different angles. And I'm focusing on one here, which is not to do with getting the inputs wrong. You could know perfectly what the future volatility of the portfolio is and its return. And you could put that into the equation. So you could know its true average return. You could know its true volatility in advance with perfect foresight and put that in the equation. You're going to get a number that actually gives you the correct future distribution of losses you might suffer at the end of the year. And that only 5% of years you're going to do worse than $200 million loss. The problem is during the year, more than 5% of those years, more than 1 year out of 20, at some point during the year, you're going to be down 200 million or more. It's going to happen more often than it does at the end, because in some of those cases you'll be down and then you'll recover. Look what happened this year, right? So it's a fundamental difference that even if your assumptions are perfect, if you're not thinking about that difference, it can actually be pretty misleading. So what we argue is that it's important to make sure that this distinction is understood, because if your board is meeting at the end of Q2 and you're already down 250 million, they may be tempted to conclude that our models were wrong, we're in a new environment, we need to revisit, we need to change course. But if you can show that actually one out of 3 times, and I'm just making these numbers up, but 1 out of 3 times, this is going to happen in the course of the year, and a good subset of those end up recovering. That information is useful to stakeholders. It helps them be prepared. It helps them put the current drawdown in context. And it can not only be important for managing stakeholders, but there's so many applications of this. I mean, imagine a company with some covenants in its bonds, for example, where if there's a certain threshold is breached, there's adverse action. Imagine a plan sponsor where if they breach a certain level, the government is going to have to kick in and make contributions. I mean, there's all sorts of real world cases where within horizon breach of a certain threshold triggers real action that is adverse. So we argue it's just important to understand that. And if there is a particular threshold that you want to avoid breaching, you can reverse engineer this and you can say, what's the volatility we should run at to avoid? And you probably want to build in a cushion and you want to stress test all the usual things. Is it a normal distribution? Is it autocross? All those things. But you can say, is there a threshold we don't want to breach? And if so, here's the volatility we should run at to continuously avoid breaching that, not to avoid breaching it at the end of each 1 year period.
Right. Thank you for that. I'm going to give the last question to Ashley Knight from Mercer. I'm going to break it up into a couple of pieces. The idea behind it is the phrase regime shift in your parlance, but there may be things that begin to occur in human behavior that are not represented at all in the past whatsoever, but we know that they're beginning to unfold. Can you bring to bear your research on those questions? How do you begin to think about estimating risk where there's a new trend that's beginning to take place? And then the twist that I'll put on it is actually with what you and I pregame, the enduring interest of our members is the climate trend. So you can also perhaps use it as an opportunity to other aspects of State Street's work.
Yeah, absolutely. Okay, so look, this I think is the fundamental challenge with using historical data, to forecast the future, right? On the one hand, you can kind of say, well, we don't have any future data, it's not on Bloomberg, so we have to use it. But that's not a fair response, because The way I look at it is this is why judgment and qualitative inputs have to come into play. And I don't think there's a magic answer to that one either. I think our view is that you can learn a lot from history. And, at least, take it to the extreme. Should we argue that we should ignore history? I think that's a tough argument to make in any realm. If we ignore it, we may be doomed to repeat it, right? So I think it comes down to a trade-off between looking at history and then acknowledging that we may be entering a new regime or a new period where that data is less relevant. Certainly, historically speaking, if you look at financial markets, there tend to be some persistent patterns. This oscillation between a quieter regime where correlations are lower and performance is higher, and a more volatile regime, whatever the cause of that volatile regime, the causes may be different, where correlations tend to go up. Most cases, some correlations like government bonds and equities will go down, but there are persistent changes in the correlations, persistent changes in the risk. So I think there's value in looking at the historical data, but you have to take it with a degree of caution and use qualitative judgment. I'm not aware of a statistical tool that will help identify and extrapolate an emergent trend. I would again just flag my colleague's paper on partial sample regression. I'd be happy, by the way, Matt, I can share the links to some of this with you afterwards. But this does help identify, I think, is where we are today relevant? Is it in any way similar to particular points in history, or is it different? And to weight those accordingly, because I think that gets at this question a bit, because it says, is history relevant or not, and which history? Because some history may be more relevant than other history. And I think there's a nice tool, this Mahalanobus Distance. This tool can be really useful for figuring out which pieces of history you might want to look at and which ones you might want to ignore. But there's I don't think there's a great universal answer to that question. It's a great question.
I appreciate it. You actually remind me of one of FCLTGlobal's founding documents written by organizations that would become our members at the point of the founding. It's called the Long-Term Portfolio Guide. And one of the central theses of that is the importance of having investment beliefs, ways that you choose to view the future, expectations that you have of it. And it's a reminder, of course, that measurement of risk is not going to be a substitute, rather a complement for having forward-looking investment beliefs. Will, I really want to thank you for being part of our second edition of this risk webinar series. This has been the webinar on data inputs for long-term asset allocation. For everyone to know, we have been talking about an FCLTGlobal report called Balancing Act, Managing Risk for Multiple Time Horizons. I want to underline, in conclusion, the incredible role that Will and his colleagues and State Street Associates played in making this publication possible at all. If you go into it, you'll see that the back half is dedicated to issues of estimation and measurement that Will and I have discussed today. It includes some real models about the way that these phenomena unfold and what they mean for long-term investors. State Street Associates, led by Will, did all of that for us and allowed us to use it in our report. And as a consequence, we were able to put this out and assist you as long-term investors in thinking about how to manage risk for the longer term. So, Will, we appreciate you today. We appreciate your help in this report. We, of course, appreciate you.
Thank you very much for organizing and for having me. Thank you. And thanks for all the questions and input. I appreciate it.
Absolutely. I also want to thank our team. Almost all of them are invisible to you in the audience today, but we could not have done this without them. So Sarah Simons, Ross Parker, Bryn Costello, Victoria Tide, Alan Heath, Sam Sterling, all played a role in making this production possible. Again, by way of reminder, FCLTGlobal hosts a webinar for the purpose of moving money in a long-term direction. To that end, I and all of my colleagues are available to you for further conversation about what this research and what these insights might mean to the way that you manage assets for the long term. You can reach me to follow up at matthew.leatherman@fcltglobal.org. Also, the documents that FCLT has published are all available on our website at fcltglobal.org/resources. So you can see that information there. I would conclude by asking everyone in the room to join us for our next sessions in this risk webinar. Episode 3 is going to be on the 14th of October on the subject of default time horizons in GIPS compliance, squarely the issues that Will just mentioned earlier in our conversation today. And then on the 11th of November, we will get at the subject of climate from uncertainty to risk. Registration is open for both of those webinars on fcltglobal.org/events. We very much do hope that you will join us for them as well. This brings us exactly to the conclusion of our webinar. Thank you to everyone in our audience for joining. Thank you again to Will and to all my colleagues, and we hope that you will be well. Good day.
Thank you.